Okay, welcome to the first video for week 8. So here what we're going to do is extend our simulations to financial planning. And the first and easiest thing is just to simulate the returns for a few investments. So, let's just pretend like we investment A. I don't know why I can't make that a capital A. There we go. Okay, so we have investment A, B, and C. Now, obviously, and I don't know why it didn't go to B and C. Doesn't look like Excel's having a very good day. Could be the operator, but I doubt it. Okay, nonetheless, finally, we got to investments A, B, and C. All right, so you're going to simulate some returns for these three investments. So we're going to use the normal distribution. Generally speaking, I think it's fair to say that we think most of these returns are normally distributed. You just have to figure out basically what the mean and the standard deviation are. So I'll start here. So we're going to get our norm.inverse function. Okay, so the probability, remember, this is from last week. That's just the RAND function. Randomly generate that. Okay, the mean. So let's say the average return, right? These are the returns for these investments. So let's say this first one, it's got, say a 20% return. But a standard deviation is pretty high. So why don't we make the standard deviation like 0.18, right? So 20% return, but, a standard deviation is almost, 0.18, which is almost equal to the return itself. Investment B, let's think of this as something like a bond. So again, we put in the RAND function. Right, so here, say the mean is, say, 0.04, and then, say, a standard deviation is, say, 0.015, right? So a smaller return, but also a very small standard deviation. And then investment C, let's see. Let's, another RAND here. Oh, I don't know. Let's say that this is, I don't know. Let's just say this is the old stock market. So, say a 16% return, standard deviation, say probably 0.10. Okay, so here are my three investments. And then what I'm going to do is copy, right? And then I'm going to go all the way down. So I'm going to try to go down, 555. And you don't need to get exact. So paste. All right. So here are all of the expected returns, right? So based on these various distributions, with 500 simulations or again 500 trials, these would be the returns. Okay, so now what I want to do is I want to go and I want to set up, my, I guess like my data chart, if you will. So it's the same thing. Let me make this a little bit smaller. Okay, so, I've got investment A, B, and C. We'll put those here for now. Okay, I'm going to do a shorten that up. Okay, so remember, you want to calculate things like the mean. Oops. What's the mean of these returns, right? How about the standard deviation? The min, the max. And then, I think it's more common, as I showed you last week, to actually do the number of losses, right? So these would be negative returns. And then your percent losses. Okay. All right, so the mean, well, that's just the average. We've dealt with that before. So no big deal, average. So I'm just going to take the average of investment A. There we go. Okay, standard deviation. So here I'm going to use the sample standard deviation function. So STDEV, hit go. and you want the .s version, right? The .s is for a sample, the .p is for the population. Obviously, this is a sample because I just made it up, so we're going to use the .s version, and of course you just highlight your sample data. So this would tell me the standard deviation of investment A, right? And these are pretty close to the means, right? 0.2, 0.18. They should be close. Okay, the min, I'm going to use the min function. There it is, min. And again, just highlight your data. Ooh, so, you know, the worst return was a negative 34%. And then we'll do the max function. So in other words, what's the highest return in this sample of 500, roughly 500 observations? 554. Whoa, 71%. All right. Okay, now number of losses. So remember, this is the count if function. And I don't think I have that. No, I do. There it is. Count if. Okay, so the range, you know, I want to count the number of negative returns for investment A. So the range is going to be all the outcomes for investment A. And then the criteria, and again, remember from last week, the double quotes less than 0 and double quotes. Yep, there we go. Okay. Oh, oops. That's a 0, not an O. Ha, there we go. There we go. Sorry. So, lesson today, make sure you hit zeros and not O's in your count if functions. Okay. And then the percent of losses. So the easiest way to do this is just to take this number. And then I know that it's 554 observations, but let me show you another way, easy way to do this. And this is to use the count function. And I don't think I have the regular count function. Nope. So I got to type it in. Count. Okay, and so what this does, I'm just going to, this says count how many observations are in this column, right? So just highlight that. Notice, you know, I don't know if you can see this on your screen, but this is 554, which is, you know, exactly how many I have. But the point is, that's a nice, easy way to do this percent losses. Then you don't have to remember how many trials you actually ran, right? Okay. So at any rate, here we have our summary data. And so, you know, I did it all for investment A. Now, if you do it this way, what's nice is, you can just copy it over, presto. Now you have everything for investment B, right? So, you know, here's the average. Perfect. Standard deviation. You know, notice that it's highlighting the investment B. Min, you know, same thing. Perfect. Perfect. Perfect, right? It's obviously, the point being is, you know, you just do everything for investment A, you can copy it over for investment C, and presto, you're done. Okay, now, I'm going to kind of semi-pause here and say, listen, this is what I would expect you to do on a homework problem or on a test question, right? Is to generate these returns. Obviously, I would have to tell you what the mean and the standard deviation are for the various investments, but you should be able to run a simulation. You know, I'll tell you the number of trials, blah, blah, blah. And then I would fully expect you to be able to calculate the mean, the standard deviation, the min, the max, the number of losses, and then the percent of losses. Okay? Now, that's what would be expected of you. Now, I want to take this a step farther. And what I hope to do now is bring this together with our linear programming, right? So if you remember this model, this was our Markowitz model that was not in the book. And here we've got some of our expected returns that we put in, and then our covariance matrix, right? Well, where can you get all of this information? Actually, that's this stuff here. Here would be the expected returns that you would put into this worksheet, right? So you would run these simulations, and then you'd calculate the mean of all these simulations. And so you would just copy this and hit paste, right? Oh, I got to paste values. Oops, sorry, my bad. Okay, paste values. There you go. Right, so you would just paste these returns right into there. And I know they moved again, but that's because all of these RAND functions are volatile. All right, but then what you have to do is calculate your variances and your covariances. Well, you've already got your standard deviation, so if you wanted to, for the variance, right, you could just square this. Oops. Right, because the variance is the square of the standard deviation, and then you could just pull this across. There would be your variances. And then what you would do is calculate your covariances. Okay, so you do the covariance, say, between A and B. So what I'll do is I'll say, like, here would be A, B, and C, right? So here I would want the covariance between A and B. So I'd get my covariance formula. Dot S again, this is a sample, right? And so for array 1, just highlight that. And then for array 2, there. So there would be the covariance between investment A and investment B. And then I would do the covariance between A and C. Okay, so highlight A. There's C. All right, so there's the covariance between A and C. And then lastly, I need the covariance between B and C. So we'll do that. Okay, investment B. And C. All right, hit OK. All right. Well, at any rate, here's your data. So then what you would do, I kind of screwed up before. What you would do now is basically take all of this information, highlight all of this, copy it, say move it over here, and I'll just put it down here for now. Paste the values, right? My point is because now all of these are the means that correspond, right, to these variances and these covariances. Does that make sense? Because every time you do something in this sheet, everything is changing, right? Because all of these RAND functions are volatile. So first do everything, then copy and paste, and then you're going to just, these were the expected returns, so you would just copy these into here, and then here are your variances, right? So you would just copy them into the diagonal of this matrix, right? And then here at the very bottom are your covariances. So your covariances, these are actually the 3 cells, right? And then also these 3 cells. And so the point is, then you put everything in here, and then you would run this Markowitz model to determine, how much the investor should invest in investments A, B, and C. And that's actually, to be honest with you, after talking to Harry, this is basically what's done, in the financial planning world. Now, I admit they probably have more sophisticated random number generators than just, say, the normal variable. It wouldn't surprise me if they have the multivariate normal random variable, so that you can allow for the interaction, right, between two investments, right? Because, you know, these investments, to the extent that they're correlated with one another, you know, as one goes up, the other's going to go up, stuff like that. Or if they're negatively correlated, if one goes up, one will go down. But the point is, you can model that using a multivariate normal random variable. And of course, unfortunately, Excel just doesn't have that particular function. So the point being is that the software that you use is probably, it's got a few more bells and whistles on it that Excel doesn't have. But basically, it's doing just this, right? It is running simulations on these various investments. You would put in the parameters, the mean, the standard deviations, covariances, so on and so forth. Run the simulations, and then this would be the actual Markowitz model that the software is using to determine what percentage of the funds should be invested in your various investments. And then, of course, you know, you're either maximizing your return or minimizing your variance. So there you go. That's kind of, hopefully, this kind of brings everything home, if you will, and allows you to see kind of what's going on with these linear programs and why we were doing them. Because this is really what financial planning is all about, running these programs and trying to figure out what's the best portfolio for the client. So, all right, well, with that said, that's it for this first video.